Picture this. You're sitting on your bed late at night, phone in hand, scrolling past a headline that says something like, "The S&P 500 just hit another all-time high." You pause. You feel that familiar knot in your stomach. Not excitement, not curiosity, just confusion mixed with a little regret. You think, I should probably be investing. Then immediately, but I don't know what I'm doing. Then finally, it's probably too late anyway. So you keep scrolling. And that single moment, that quiet decision to do nothing, is how most people lose hundreds of thousands of dollars over their lifetime without ever realizing it. My name is Bales, and I spend an unhealthy amount of time thinking about the invisible rules of money that nobody explains, especially the ones that keep normal people on the sidelines while everyone else seems to magically get ahead. If you've ever felt like investing is only for rich people or math geniuses or people who somehow got in early, this video is for you. Because today, we're not talking about hot stocks or day trading or turning $1,000 into a Lamborghini. We're talking about how investing actually works for beginners and why the biggest mistake people make has nothing to do with picking the wrong stock. Here's the first lie most people believe. They think investing is risky, but mathematically, not investing is the riskiest financial decision you can make. Let me explain. Imagine two people, same age, same job, same income. Let's call them Alex and Jordan. Alex keeps their money in a savings account because it feels safe. Jordan invests slowly, boringly, and consistently into the stock market. Alex looks responsible. Jordan looks reckless. But here's what actually happens over time. Alex's money loses value every single year to inflation. Even at a modest 3% inflation rate, money quietly rots. Prices rise. Purchasing power shrinks. That savings account isn't protecting Alex, it's slowly bleeding him out. Jordan, on the other hand, isn't doing anything fancy. No options, no crypto, just buying pieces of real companies through index funds. Historically, the stock market returns about 7–10% per year over long periods. Not every year, not smoothly, but on average. Over 30 years, that difference becomes massive. Alex thinks they're avoiding risk. Jordan understands that risk is unavoidable. The only choice is which risk you take. This is the first mental shift beginners have to make. The stock market is not a casino. It's a machine that rewards patience. But here's where most people freeze. They hear stock market and picture day traders screaming at screens, red and green charts flying everywhere, and people losing their life savings overnight. That image is so powerful that it keeps people paralyzed. And that fear is extremely convenient because it keeps you out of the game. In reality, when you invest in the stock market the smart way, you're not betting on individual companies. You're buying ownership in the entire economy. You're saying, over the next 20, 30, 40 years, I believe humans will continue to build things, sell things, and solve problems. That's it. That's the bet. And historically, it's been a very good one. But beginners don't lose money because the market is unpredictable. They lose money because they start with the wrong goal. Most people think investing is about getting rich. It's not. Investing is about not falling behind. If your money isn't growing faster than inflation, you're running on a treadmill that's slowly speeding up. You can work harder, save more, budget perfectly, and still feel like you're stuck. That's why investing isn't optional anymore. It's defensive. And the biggest beginner mistake isn't choosing the wrong stock. It's waiting for the perfect time to start. Because there is no perfect time, there's only time in the market. Now that we've killed the myth that investing is only for experts, we need to talk about the part that actually stops most beginners, where to start. Because this is where people spiral. They open YouTube, they search how to invest, and suddenly they're drowning in advice. Buy this stock, avoid that crash, follow this strategy, time the market, beat the market, and after an hour of research, they do exactly nothing. This is called analysis paralysis, and it costs people more money than bad investments ever will. So let's strip this down to the bare essentials. If you are a beginner, investing is not about being smart. It's about being consistent. Here is the simplest framework that has quietly beaten most professional investors over time. Step 1. You need a brokerage account. This is not complicated anymore. You don't need a financial advisor. You don't need to walk into a bank. You open an account online in 10 minutes. This is just the container that holds your investments. Think of it like a checking account, but instead of holding cash, it holds ownership in companies. Step 2. You buy index funds. This is the most important word in this entire video. An index fund is a basket that owns hundreds or thousands of companies at once. When you buy one, you're not guessing which company will win. You're betting that the economy itself will grow over time. This is why beginners should almost never pick individual stocks. When you pick a single company, you are saying you know more than millions of professional investors, hedge funds, and analysts whose full-time job is to analyze that company. That's not confidence. That's arrogance. Index funds remove ego from the equation. Now here's where beginners make the next mistake. They think they need a lot of money. They don't. The market doesn't care how much you invest. It only cares how long you stay invested. Someone who invests $200 a month for 30 years often ends up with more money than someone who dumps $10,000 in once and panics at the first downturn. Because investing success is mostly emotional, not mathematical. Let me explain. The market will go down, not might, will. And when it does, headlines will scream. Social media will panic. People will tell you this time is different. This is the moment where beginners destroy themselves. They sell. They lock in losses. They swear off investing forever. But here's the truth. Nobody tells you. Market crashes are the reason investing works. Crashes are when stocks go on sale. They are the price you pay for higher long-term returns. If the market only went up smoothly, everyone would be rich. The key is automation. Set up automatic contributions. Same day, same amount. Every month. No thinking, no timing, no emotions. This turns investing into a background process instead of a stressful decision. And this is where something powerful happens. You stop watching the market. You stop checking your balance. You stop obsessing. Your money quietly goes to work while you live your life. Now let's talk about a dangerous lie. Beginners hear all the time. Wait until you know more. You will never feel ready. Knowledge doesn't remove fear. Experience does. The market is the greatest teacher there is, but only if you show up. Your first investments won't be perfect. They aren't supposed to be. The goal isn't to optimize returns. The goal is to build the habit. Because once investing becomes normal, it stops being scary. And once it stops being scary, it starts working. At this point, you understand how to invest. But understanding isn't what separates people who succeed from people who don't. The real divider is time. Most beginners don't fail because they pick the wrong fund. They fail because they quit too early. Here's what usually happens. Someone starts investing. They put money in for a few months. Nothing exciting happens. No dopamine hit. No dramatic gains. No feeling of progress. So they lose interest. Or worse, the market dips right after they start. Their balance goes down. And emotionally, it feels like confirmation that they were wrong to begin with. This is where the trap snaps shut. Because investing doesn't reward effort. It rewards endurance. The stock market transfers money from impatient people to patient people. That's not a motivational quote. It's a mathematical description. The first few years of investing feel useless because compound growth is slow at the beginning. Your money is working, but it's whispering, not shouting. People wildly overestimate what investing does in 1 year and dramatically underestimate what it does in 20. That's why the real purpose of investing isn't to get rich. It's to buy optionality. When you invest consistently, something subtle starts to happen. Your money begins to generate money without your time attached to it. At first, it's small, almost insulting. But over time, it grows into something powerful, leverage. Leverage means you're no longer trading hours for dollars at a 1-to-1 ratio. It means your future self is quietly helping your present self. And this is where investing becomes emotional. Because investing isn't about numbers, it's about fear. Fear of starting too late. Fear of losing money. Fear of being wrong. Fear of looking stupid. So let me tell you something clearly. You will make mistakes. You will invest before a downturn. You will doubt yourself. That's not failure. That's the cost of admission. The real failure is never starting because you wanted certainty in a system that doesn't offer it. The market doesn't reward certainty, it rewards participation. So here is the simplest version of how beginners should think about investing. You are not trying to predict the market, you are trying to outlast your own emotions. If you can keep investing when it feels boring, scary, or pointless, you win. And eventually, something strange happens. You stop worrying about money as much. You stop panicking over every expense. You stop feeling like one bad month could ruin you. Not because you're rich, but because you're building momentum. Momentum is what changes lives. And the saddest financial reality is this: most people never lose money in the market. They lose time by standing on the sidelines. So if you're watching this and you've been waiting for the perfect moment, this is it. Not because the market is perfect, but because you finally understand how the game is actually played. Start small, stay consistent, let time do the heavy lifting. That's how beginners become investors. And that's how investing quietly changes everything. If this video helped you see the stock market differently, share it with someone who's still scared to start. And subscribe, because we're going to keep breaking down money in ways that actually make sense. Thanks for watching.